Over the past week, crypto venture capital funds made strategic adjustments to their portfolios. Data from Scopescan, analyzed from June 23rd to June 29th, shows that top VC funds have increased their holdings in RNDR, QNT, and FTM, while reducing positions in MASK and FLOKI. These moves followed substantial downturns in these assets over the past month. Major buys, major sell-offs, a rationale behind VC fund activities. VC funds such as Alameda Research, GSR, Tata Labs, Autonomy, and Cumberland increased their holdings in RNDR. This led to a net token change of 35,188.43 and a net 44. And one continues to cost a video to a clear scouting. And research a fight frank, it can be greater as a cost of basal on time. And Western Shop is still seeing Poppy of 15.1 rise. And FTM also attracted investments from Wintermere Trading, Falcon X, and Alpha Lab Capital, with a net accommodating rise right here for a modern 81. VCs likely pursue these investments to take advantage of depressed prices. This strategy involves acquiring assets that have experienced significant price declines with the expectation of future recovery and value increase. For RNDR, QNT, and FTN, price drops of -21%, -13%, and -24% in the preceding month created attractive entry points, rebounds, and long-term gains. Anticipating that these assets are undervalued and will appreciate over time. MASK and FLOKI faced large sell-offs. Wintermere Trading and GSR reduced their MASK holdings by -192, 242 tokens, 650 tokens, and down by 14.23%. Its high is so on face, and the reasons behind VC funds choosing to sell these tokens are intriguing. MASK experienced a 30-day price decline of 93.83%, while FLOKI dropped by 32.76%. Over the past 7 days, MASK's price increased by 9.41% and FLOKI's by 12.06%. Despite the drop in prices over the past month and the recent slight surge unlikely accounting for profit, VC decided to liquidate their positions. This move suggests a calculated strategy rather than a reaction to immediate market conditions, potentially aimed at optimizing portfolio balance or managing risk exposure. When evaluating VC fund activity, it's important not to simply interpret buys as bullish and sells as bearish. Multiple strategic reasons can drive their decisions to buy or selling assets. Portfolio rebalancing, adjusting the portfolio's composition to maintain a desired risk profile or capitalize on new opportunities. Profit realization, locking in gains after a period of price appreciation to ensure investment returns. About 659 million people in a 0.2. And there's also all the things that are fighting to this risk. Mitigation, reducing exposure to assets perceived as high risk to protect the overall portfolio. Liquidity requirements, generating cash flow for operational needs or funding new investment opportunities. The regulatory considerations, anticipating changes in the regulatory environment that could impact the value of holdings. And then, they do about tax optimization, selling assets to optimize there being tax outcomes such as offsetting gains with losses elsewhere in the portfolio, macroeconomic factors, reacting to global economic trends that suggest better returns might be available in other markets. The diversification, process of timers, ensuring the portfolio remains diversified across various asset classes to reduce risk. I'm looking at the past week's performance. The positions in RNDR, QNT, and FTM are already in the green. However, the sold-off MASK and FLOKI are also performing well. This outcome raises questions about the long-term effectiveness of the VC strategic decisions. Will the gains from RNDR, QNT, and FTM continue to outpace MASK and FLOKI, or will the decision to reduce positions in MASK and FLOKI ultimately prove less beneficial? Only time will tell.